is a performance-enhancing market trick called window dressing, putting your investments in jeopardy. It's a technique used by fund managers to boost their yearly returns by pumping up stocks to benefit the fund's share price for the short term. Joining us now to protect your money and the risks, understanding the risk better, is CNBC senior analyst Ron Insana and Art Cashin, director of floor operations at UBS. Gentlemen, good to see you. What exactly is window dressing? Let's get right to the source of this issue, because we see it every year, right, Ron Insana? Explain it.
Well, now it depends. You know, when Art Cashin and I have been doing this for 28 years together, when we first started talking about it, it was a way for a portfolio manager not to look dumb. If he hadn't invested in IBM and the quarter was coming to a close, he'd buy some so it was on his portfolio statement and his investors wouldn't ask why he didn't own it. Now, this is what they're talking about in the Wall Street Journal today with respect to buying stocks in order to run them up at the end of the quarter and boost performance if you have, for lack of a better description, investile dysfunction. This is the Viagra for portfolio managers.
Yeah.
You drive that stock up at the end of the quarter, sell it when the quarter ends, and boost not only your returns, but potentially your fees as well.
What do you think, Art? You seeing a lot of window dressing these days?
Well, it's difficult. It really only works in relatively thin stocks.
Yeah.
But the problem is that if you're a regulator and you come in and you say, Ron Insana, why did you buy so much of that stock in the final 10 minutes? And he would report, because I like it. I already own it. You see how much I like it, because I own it. And that was the primary defense. And you haven't seen a great many big prosecutions in this area. Interestingly enough, one of the areas that they did about 25 years ago prosecute some folks on was running a options portfolio. And they marked the stock up to make the options more attractive, so they got a bigger bonus from their firm.
Yeah, and they closed the stock on the strike, too, right, Art? So that the options owners didn't make any money.
That's right.
So, I mean, are you expecting, Ron, that we're going to see various sort of techniques at year-end to make the portfolios look better?
No, Maria, I think now that this has become so public with the Wall Street Journal article that focuses on this movement of very thinly traded stocks, I think people will be deterred. I think one of the things that individuals have to watch out for is that, one, they don't invest in this micro cap world that is so easily pushed around. They were talking about one stock in the article that had a market value of $36 million. Any individual can move a stock with that kind of market cap. So you want to stay away from funds that invest in those types of securities, and you don't want to necessarily trade them yourself, because you can be on the wrong side of that trade, as the manager in question may be taking advantage of your position on the other side.
So you're not, it sounds like the both of you are not really necessarily seeing a big impact from this right now.
No, I don't think so. And I will tell you, over the years, general market conditions can work against you. You might want to move something up, but if it's a bad day for the market, sometimes window dressing looks like window washing or even window breaking sometimes.
That's funny. So Art, you wrote today about what we're seeing in terms of tax changes and in terms of withholding. Talk to us about that.
Well, the fiscal cliff, one of the things, if we're really going to go over it and change the tax basis, the Treasury's got a call on corporate America to change the withholding tables. All of us get taxes withheld, and if they're going to change what rate I'm going to be taxed at, they're going to have to change that table. Now, that's not an overnight process, and certainly the Treasury can't afford to let that go too long, because everybody will be under withheld, and they'll get a big tax bill, and there'll be a riot among the people if that happens. So what I'm watching is the Treasury, and if they get nervous enough, they'll ask them to change the tax tables. So far, it looks like they smell a deal, and they haven't asked for it yet.
Yeah. So you think we're going to get a deal, Art?
I think they may try to push it till the end. The other thing I'm watching for is the 17th, when the president's due to take his family to Hawaii. I don't think he wants to be in Hawaii without a deal, so something's going to come up.
Maria, Ron, what about you?
Really interestingly, I thought, the resignation of Senator Jim DeMint, who was a staunch conservative today, which was a surprise departure, tells me that the Republicans in many ways are throwing in the towel on this deal. He was a guy who fought tooth and nail against this type of thing, against raising tax rates. He may want to work from the outside in, which is the way the press is portraying this, but it looks like too many Republicans are beginning to throw in the towel. They may find a compromise that isn't necessarily Clinton-era tax rates, something in between, but it looks like the makings of a deal with every change that comes on the Republican side more and more likely to happen than not.
All right, we'll see about that. We'll be watching. Obviously, very, very important for the markets. Thanks, guys.